Okay, hi everyone. Welcome to lesson 29, where we are going to look at closing entries. So, throughout the course, we have looked at the accounting cycle and we have gone through almost all of the steps that are required within that accounting cycle. So, at this point, we are looking at how to close certain accounts so that we are preparing ourselves for the next fiscal period. Okay. So, closing entries are journal entries that are made at the end of the fiscal year in order to reset specific accounts to zero. So, not all accounts are going to be what we call closed. However, some are. So, the accounts that are going to be closed at the end of every single fiscal period include revenues, expenses, and drawings. Maintaining a zero balance in certain accounts is essential for a business to accurately compare performance across different periods, especially regarding income. And this another reason for this is because of the gap that entails the time period concept. So this IFRS rule states that financial reporting is done in equal periods of time. And so for that to happen, we need to prepare all the accounts for the next accounting cycle. So in order to do that, we need to close our revenue accounts, our expense accounts, and our drawings account. Okay, so our nominal accounts, again, are temporary accounts. So they're only temporary for that fiscal period. And those, again, are revenue, expenses, and drawings. And our real accounts are permanent accounts. These can stay open from year to year. And these include our assets, our liabilities, and our capital. Okay. Now, keep in mind that revenue and expense accounts are a part of the income statement. And our drawings account appears on the balance sheet under the owner's equity section. So remember where to find each one of those accounts. Okay, so how are we going to close these accounts? Well, we use a temporary account called the income summary account. And again, it's temporary because we only use it during the process of closing the accounts. And it summarizes the period's revenues and expenses and helps clear those accounts out. So it helps bring the revenue and the expenses to a zero balance. So steps in closing the accounts. We're going to go through an example in a minute, but I just want to bring attention to the steps. So step one is to bring the accounts up to date. And in this case, we're journalizing and posting the adjusting entries. In step two, we are going to close the temporary accounts. Here, we're going to transfer the balances of revenue and expenses to that new income summary account that I was just talking about. And then once we have our expenses and our revenues in that income summary, we can bring the income summary and our drawings accounts to the capital account. And then at this point, all of the nominal accounts will have a zero balance. And our final step is to take off a post-closing trial balance. Okay, so let's see it in practice. Let's look at these journal entries. So our first closing entry will be revenue and closing revenue. So as we know, revenue increases our owner's equity. It typically has a credit balance. So in order to cancel this revenue account out and to make it have a zero balance, we have to do the opposite. And so in this case, we are going to debit revenue. So if our revenue account is at 600,000, we're going to debit 600,000 and we are going to credit that income summary account for 600,000. So our debits are still equaling our credits. And again, it's just so that we can transfer slowly the revenue and expenses to our capital. So we're going to use this income summary for a little bit. Here's another example. Let's say you have more than one type of revenue. So in this example, we have commissions revenue and sales revenue. Well, we're going to debit both accounts, okay, for whatever their balances are. And then we're going to credit income summary. Okay, so same thing here. Doesn't matter if you have one revenue account or more than one. We do the same thing. We debit revenue and we credit our income summary. Here's another example. Actually, this is the first example, but it shows you the T account. So note that now when you do this, revenue account is closed. So if I have my revenue account, I had a 600,000 credit, then I closed it out by debiting that 600,000. So, 600,000 minus 600,000 is zero. So I have a zero balance. And now my income summary has a credit of 600,000. Okay. The next step is to close our expenses. So again, here are a couple of different examples. So here, if we have bank charges, right, just one expense, you're going to notice it's the opposite because as we know, expenses, they decrease our owner's equity. And so they typically have a debit balance. Well, to reverse that, we need to put the expenses in as a credit. So here I have a credit of $12,150. My income summary, this is a mistake, but it should have $12,150 as a debit. So unlike this revenue example, when we credit income summary, in this case, we're debiting income summary because again, we're doing the opposite. Here's a better example. We have income summary for 400,000, okay? Because we're crediting these three expenses, we have ad, rent, and wages. 100 plus 200 is 400,000. So again, this is what our T account would look like. If we had our expenses for 400,000, typically they would have a debit balance. If I credit, then I bring my balance to zero, and my income summary will now have a debit of 400,000. Okay. My third closing entry is income summary. So income summary is so fast. We just use it for, a couple of transactions or journal entries here, I should say. But we have to actually close it. So where do we close it to? Well, we close it to capital. So revenue minus expenses, okay, provides us with our net income. So we put whatever net income we made throughout the year into our capital account. So if we, for example, had revenue of 600,000, which we did up here in this first example, okay, 600,000, and we subtract our 400,000, which came from this example right here, okay, these are together, then you are putting 200,000 into your capital. So in this case, I would be closing my income summary for 200,000 and I'm increasing my capital for 200,000 because as we know, net income increases our capital. So we have a net income in this case because our revenues are greater than our expenses. So our income summary now is closed and we have accounted for our net income for that fiscal period and it has been brought into our capital. Okay, so here is what the T accounts would look like. So when you take net income and the debit income summary, then you take net income and debit income summary, then put the numbers in the capital. When you do this, the income summary account gets closed. Lastly, our drawings. So drawings don't go into income summary, as you will see. They go right into capital. So because drawings decrease our owner's equity, we're going to do the opposite. So we're going to decrease our capital for $100 if that's what our drawings were, and we are going to credit our drawings account for $100. So as you can see, our drawings account would typically have a debit of 100. To close it out, we put it as a credit and we would have to debit our capital. So in this case, you credit drawings, then put the number in the capital. When you do this, the account gets reduced by the amount of the drawings and the drawings account gets closed. So just remember that you need to close revenue and expenses into the income summary. Once you have found your net income, you close the income summary and then you close the drawings account directly into capital. Okay. And when you're doing this, when you're trying to figure out if you need to debit or credit, you do the opposite of what you normally would. So revenue, typically a credit, but when we're closing, we put it as a debit. Expenses, typically a debit. When closing, we put our expenses as credits. Our drawings, typically a debit, but when we're closing, we put it as a credit. And income summary, if we have a net income or net loss, that will depend what side of capital. Are we increasing our capital or are we decreasing our capital? Okay, I hope this lesson helped. If you have any questions or concerns, please send me an email and let me know.